Hey guys, hope you're all doing well. In this video, we are going to see how we can build an amortization table. And what is an amortization table, which also known as amortization schedule? This is a table that used by lenders, such as financial institution, bankers, to present a loan repayment schedule based on a specific maturity date. So an amortization table also shows exactly what you will be paying each month or each period for the entire time of your loan or mortgage. And the table will also show you your how much of that will go toward your loan principal balance and also how much will be used as interest. To start this, I would strongly suggest that you build a very clear and solid input table. So this will help you every time you want to play with this table to see the different terms of payment and also a different interest rate. You don't need to change any formula here in this table. You only need to change only input information here, and the table will be automatically updated. For your input information, you need your principal and loan or loan. In this case, let's go with 300,000. You need the term or number of years that you want the loan. Let's go with 20 years. Your annual interest rate, let's assume that would be 7%. Your payment frequency, as most of you are familiar with this, you can make your repayments by every month or every week or even bi-weekly, or for just companies, they can make this payment and based on annually or even semi-annually. So you can simply enter this like manually every time that you want to put some input here. But the easiest way would be just building a drop-down list based off of this information. And as you know, in 1 year, you do have 12 months. You do have 52 weeks. You have 26 bi-weekly and 2 semi-annually and 1 time per year. So, and if you don't know how to build a drop-down list, I have recorded a video which you can find in my channel that shows you how to build a drop-down list very quickly. So for that, we go to data, and we're just simply choosing this one, and this is our list, and voila. So you would be able to choose any of these. And for the number of periods, this is going to be dependent on this one. Okay, and before just jumping to the other three, normally in businesses, and for those of you who works like in accounting or finance, you know that most of the tables that have entry, they are going to be marked in blue. So this tells you that these are for you to enter your information. The rest that are like blank, that means they have formulas or they are fixed with numbers. So you don't need to touch them, and you are not supposed to touch them. So here, number of periods per year, it's based off of this payment frequency. This is also going to be doable in two ways. You can build this based on the dependent drop-down list, which if you would like, please let me know in the comment section of this video. I would build another video for that. But just for simplicity, you can also rely on VLOOKUP. Just simply VLOOKUP this value from this table, and you should be fine, because every time that you choose the other options, let's say you said this change to the exact numbers, and you can hide this if you don't want the other people to see that, or you can keep it in a separate tab. Your total period would be your number of period per year times your terms, and the period interest rate, basically the interest rate that you hear everywhere, it's an annual interest rate. But if you're making your payment every month, or even just one time per year or two times per year, this is going to be applied divided by the number of period per year. So in this case, this would be this divided by number of time. And look at here, if you change this to monthly, your rate also changes. So that means the effective rate for each month would be 0.0058, and not 7%. Okay, now that we have our inputs ready, let's start with our table. Your amortization table has usually 5 to 6 rows. In this case, we go with the simple one. The first column shows you number of period. The second one shows you how much you are going to pay for every period, your installment. The next column is going to spell out how much of this payment is going to be interest, and the other column shows you how much of this payment it's your principal. That means it's going to reduce the balance of your loan that you owe to the bank. And finally, this column shows you the balance at the end of each period. So let's start with period. For period, you can just I don't know, if you don't want to put any formula, that should be manually. That means you'll start 1, 2, and then you go and keep like copying this down the road. But we don't want to make this in this way. So what we want to have here is that we want a column, or even for the whole table, we want a table that it turns on and off formulas when we change this frequency of payment. So that means if I'm going to start with let's say with the first one, and then I'm going to show you what exactly we are looking for to fix here. The first row is your to date. So just simply start with 0, and then today, or day 0 or day 1, you don't make any payment, you just get your loan. So lock this balance here, and in day 1 or period 0, you just get your money. And in period 1, you are going to pay your first payment, or your first installment. So this rows, we are going to use rows formula. And what this formula tells you is that it tells me that I'm staying here, and I want to start counting these rows based off of this first row. So we go with, I'm saying I'm in D13, and make sure to lock this for the number of rows, and then again D13. So as you see here, if I drag down this, it is just gonna automatically count this. But as I mentioned, we do want to keep row first as a 0. Just simply make it -1 and drag it down. And you can just, I don't know, drag this up to how many period you are expecting to see for your amortization table. Let's say for this one, we're gonna just drag it down for 360 rows. And again, in this case, again, I just drag this down by using the scroll down and keeping this as it is. But there are lots of short keys that you can use them and quickly copy paste the formula down the road. But I'm not going to make this more complicated. Just we're going to simply focus on preparing the amortization table. And the other thing that we need to fix is that we want this to be interactive. That means if you change this to an annually, you're still seeing like 360 numbers here. But you want to make sure that if you choose annually, you want only see 20 rows here. So how we can fix this, before, just remember, keep a copy of this, and then we're going to use a conditional formatting. It says if this is greater than our total number of period, and just make sure to lock this. I just intentionally highlighted that. Lock, make sure you just lock this cell. If this is greater than that one, you are going to tell this show me nothing. If not, keep counting and close. And just this, for the second time, you just double click here. It goes down the road up to the point that for the first time you chose here. And look here what is going to be. If you choose semi-annually, you are expecting to see only up to 40, you see? And the other rows also contains formula, but because you put the conditional formatting here, and if condition, you won't see any number showing up here. And for the other type of payment as well. Then when it comes to the payment, you just simply choose PMT. The PMT, it's calculating your installment off of your balance of your loan. And this formula, and if you hold just your cursor here, it tells you calculate the payment for a loan based on constant payments and a constant interest rate. So just simply to show you, this is gonna show you, this is gonna ask you a couple of information. Your rate, which is going to be your period rate. Lock it. And then what else it asking you? Number of period, the total number of period. Again. And then it is also asking you the present value. The present value is the total amount that you got today as a loan. You also look this, and then voila. So this is normally showing you, because this understands cash flow, and when your inflow is positive, from your standpoint, when you get the money, that's inflow, it's positive, and what is going out is negative. But in the table, you don't want to see this as negative. You want to see, or we want to show it as positive, just put a negative here. Again, if you drag down this, it goes down the road until when you are making payment. Okay, every time you are supposed to pay this constant installment. This also, you want this to be dependent on this column. That means every time that, let's make this way, this is gonna be just look at this one. The first row shows us up to 20 period that we are making every year, one payment, but this goes down the road. So what you are gonna need, you need to fix this formula based off of this. What we can do is that we says, okay, you know what, just again, make a copy from this, and we are going to say again an if condition. If this column is something other than 0, or just make this way, if this is empty, then show empty. If not, calculate the PMT. And then, you see, it goes up to here. And again, all of these cells, they do have formulae. And if you want to see the formula again, you just add an if condition based off of this column, and you would be safe. The interest. Now, these two next columns are going to be the breakdown of your installment. That means what portion of it is interest, and the other portion would be your principal paid. So the interest is just simply your loan, which is gonna be locked times the interest. Oh, we don't need even just and hit enter. So of 28,000, the 21,000 of this one is going to be your interest. And just to make this correction, make sure that you are paying interest on the ending balance of each period. So don't fully lock this. Excuse me. Make sure you just lock the column and not the rows. And every time, so just for that, simply hit F4. Let's say one time you're gonna, let me show you. By default, this is not locked in any cases for the row or for the column. But if you hit F4 one time, you're gonna lock for the whole cell, for the entire cell. If you hit another one, you're gonna lock it for the row and not the column. And if you drag the formula, it moves through the column. And if you hit another time, you're gonna lock it on this one and hit enter. So again, you see that one. This is there is a reason that, because the zero, in here we are supposed to calculate the interest based on this. Here we are supposed to calculate the interest based on the end of period for the last payment. Again, for this, we want this to be smart. So that's why make sure, again, add a condition here. If this is 0, show us 0 or empty. If not, calculate or show us the interest rate. And drag it. See? Okay. Now, the principal pay is very simple calculation. Simply, whatever is your full installment minus the amount of interest, the rest would be the principal, the actual payment that you're paying. And literally, let's say for 1 year, for year one, if you pay 28,000, that means 21,000 that one is interest, and only 7,000 of that one is going to reduce your balance, the balance of your loan. Again, make sure to add if formula. If this friend is, then put this. If not, show us the number. And voila. Again, this is not going to be accurate until we finish this one. Your ending balance for each period would be whatever you pay as a principal reduced from the original amount of your loan. And if you see here, so what you need to do is that you add the if here, if this is equal, if not, so you see here that tells us somewhere our formula is broken. And where is that? We're gonna look at this one. Here we tell this that okay, age 13 times b. Okay, you see. Make sure this. If you don't lock this interest rate for per period, every time that you go down, before just fixing that, I can show you. And every time you want to see what is the root for your formula, just hit F2 and it shows you. And now for each row that you go down, this is going to be automatically picking, when it's not locked, it's gonna pick up the interest rate from the relevant rows one down the other one. So to fix that, make sure to fix your interest. And this came up as a troubleshooting training as well. So just here, if you try, and voila. So now this amortization table shows us exactly what we need. We have 20 period. We are going to pay out the loan to see the payment of the loan for the period of 20 years with one-time payment per year. This is going to be simply smart table, and you can try with different items. You choose monthly, and you are going to see 300, what is the, or even more, yeah, 240 months. You have it in 20 years, and you see that. And look how much we are going to be charged from the bank or lender every time. In your last payment, you're going to only pay off of 2,300. Only $13 it's your interest that you're paying. Like almost the whole amount is going to be principal. But look at your first day. Whatever you are paying, it's almost interest, and only just 500 or 600 of that is the principal payment from your loan. You can also play with this bi-weekly, monthly. You can play now every time that you want to use this for, I don't know, your car loan, your mortgage, whatever you want. You can build this one, and if you want to apply for a loan, you want to make sure that you are going to be able to just get it, or even it's better to say you can afford this or not based on the monthly payment. So hope you like this video, and if so, it would be very great that you give this a thumbs up, and I would really appreciate if you provide me your feedback in the comment section of the video, and also if you have some other subject or topic that you want me to cover it, please ask me for that. And if you're not subscribed, I would really appreciate if you subscribe to my channel as well. And thank you, and see you in the next time.